Hi, this is Russell Palomar. I'm the CEO of Pengana Capital. Thank you, everybody, for attending the webinar today. What I'm going to do is give an introduction to the Pengana Private Equity Trust raising that we are doing. And then after I've given my introduction, I'll hand over to Aris Hashu, who's a Managing Director at GROSVENOR Capital, to talk a bit about the portfolio and how it's been constructed and some background to the private equity industry. And at the end, I'll pick it up again and talk about the specifics of the offer and how it's structured and the timing, etc. So private equity is a very interesting asset class, as we see frequently mentioned in the press. We at Pengana have found, going around speaking to our investors, that there is a lot of demand for private equity as an asset class. This is driven by the dynamics of the private equity market, and also by the fact that it's become very popular at the big end of town to have significant allocations to private equity. And we can see that in Australia, even with investors such as the Future Fund, which have a large amount of their portfolio in private equity. The Future Fund today has approximately 16% of their portfolio in private equity. So what we've done in the Pengana Private Equity Trust, for the very first time, we are bringing high quality global private equity direct to individual investors and advisors in a listed format. And this is a first in the Australian marketplace. On the screen in front of you, you can see our syndicate members. You should feel free to contact any one of them if you've got any questions. Alternatively, speak to anybody at Pengana, and there's details of contact lines. And we encourage everybody who has financial advisors to speak to your financial advisor as well. So before I begin and talk about private equity, let me touch on Pengana and who we are, just for information. For people who are probably not as refreshed as they should be about Pengana. So Pengana is a diversified funds management business, and we focus on equities. Our business spans international equities as well as Australian equities, and we have a range of funds within both those categories. Private equity is a natural extension to our business, and in particular because private equity provides some attributes that we are keen to deliver to our clients, both in terms of performance, but also in terms of risk mitigation, type of strategy that can perform well in various market conditions. So it's been a natural for us to tend towards private equity as an asset class. So why is private equity such an interesting asset class? And Aris will go into some more detail about this, but just in summary, private equity is a very big market. In fact, if you looked at all companies in the US and Europe with revenues in excess of $10 million, then 98% of those companies are actually private. So if all you're doing as an investor is investing in listed equities, you're effectively ignoring 98% of the opportunities in the market. I've been asked the question before as to if that was, instead of that being $10 million, that was $50 million. The answer is quite similar. Only 6% of companies with revenues in excess of $50 million are actually listed as well. Secondly, portfolio diversification. Private equity has shown over many long-term periods to be a superior asset class in terms of performance relative to listed equities. But it's not just returns, it's also the lower risk of those returns and the low volatility and relatively low correlation with listed equities that is particularly useful in a diversified portfolio. This can be seen specifically in times of market downturns, when private equity has traditionally performed particularly well in relative to how the market performs in general. I will, in putting together private equity portfolio, it's important to be able to invest with the best private equity managers around the world, or what we think of as top-tier private equity managers. This is an extremely difficult task for a few reasons. Firstly, most direct investors would not have no idea who the top performing private equity managers are globally. We are not talking about the types of managers who we read about in the newspapers, for instance, a Blackstone or a KKR who might raise many billions of dollars, or 20-30 billion dollars in their private equity funds. We're talking about the smaller, or what we call middle market managers, and in our view, that those managers are the best group of managers on a risk return basis. In order to invest with those managers, you need to know who they are, and ordinary investors or non-institutional investors would not have that type of information. Secondly, even if you did know who these managers are, most of them are closed to new investors. Every time they raise money, they get inundated with requests from the existing investor base, so they usually do not open up to new investors. And finally, even if they did open up to new investors, usually the minimum ticket size would be $10 million. So this whole universe is out of reach for ordinary investors, and we have in our structure now, for the very first time, brought this opportunity to investors. So how have we done this? The key to this was to find a investment partner, investment manager who is a specialist in private equity investing, and who has access to these types of managers. GROSVENOR Capital is in our view the standout performer globally when it comes to access to these top performing medium-sized managers. They've been doing this for many years with a fantastic track record, and we have therefore partnered with GROSVENOR Capital, who will be the underlying investment manager for the strategy. I'll now pass over to Aris Hatch, and Aris can talk somewhat about the background of the private equity markets as well as GROSVENOR specifically. Thank you.
Perfect. Thank you, Russ. And I'm also actually joined by Executive Director from our strategy group, Jonathan Hurstred, on the line, who will be assisting with some of the Q&A at the end of the session. As Russ said, my name is Aris Hatch. I'm a Managing Director with GCM GROSVENOR, and I'm absolutely delighted to share this opportunity with you folks today and to bring this investment opportunity to the retail market in Australia. The first of its like that GROSVENOR is able to participate in, and we believe is an innovative solution. As Russ mentioned, the platform that GROSVENOR brings to developing this solution is one that has been investing in alternatives for a very long time, going back to 1971 actually, with a 20-year track record in private equity specifically. And we invest in all alternatives, and I'll tell you a little bit about why that is important, particularly to this solution. You can see it includes everything from hedge funds, private equity, real estate, infrastructure, as well as strategic investments. And the team that is managing all of those moving parts is over 500 strong across 13 offices, 162 are which are investment professionals. Now, the clients we work for are all institutional. Those who have entrusted us with their capital comprise about 95% of our AUM. This particular solution we're discussing about will be sitting side by side with the solutions that we've created for some of the world's most sophisticated investors around the world, global sovereign wealth funds, pension plans, endowments, foundations, and public pension plans as well. It's also important to note that as a platform, GROSVENOR has approximately 76% of our capital that is in bespoke solutions. Now, when I say a bespoke solution, I'm talking about a separate account that is designed specifically for one client's need based on a risk-return profile. And that is exactly what we're executing on here for the PE1 Pengana lit solution. Now, that means that we are conducting a pro rata allocation where this solution is participating alongside with those other meaningfully large global institutional investors. The minimum to partner with GROSVENOR is approximately 100 million US, and we have clients as large as over 2 billion, just to give you some context. Now, why it's important to note that we are a bespoke solution provider is that we are not raising a commingled fund and then sitting out of the market for 3 or 4 years, investing it over a cycle before returning to the market to raise capital. Again, we are actually always in the market. We always have an active pool of capital for which we're seeking the best opportunities around the world for our clients. And I will show you how that translates to significant deal flow and manager access that Russ alluded to, which are important in the portfolio construction process. Now, what I'm going to do is tell you 6 key facts about private equity that we would want anybody considering this solution or a private equity investment to consider. A short overview of the nuts and bolts that comprise the moving parts of building a solution, and then what we believe is the differentiated approach that Grosvenor brings to construct the solution on behalf of our clients and exactly what that portfolio will look like. You can see here a summary of just what private equity is, 3 main categories: buyout investments, special situations, as well as growth equity. They represent companies that have established revenue models and proven business models as well, referenceable clients, various stages of the spectrum. What I want you to notice is what private equity managers do once they have been entrusted with their capital. Private equity is exactly what it is called in its name. It is private. This is not information that you can look up about a company on a Bloomberg terminal or read about in any trade magazine or do any research on. Private equity is based on being in the market, being in the flow, having tenure in the business, and access to information. What you do with that information and that capital is what develops the value in a company and in a portfolio. And this is an example on the right side of some of the levers that private equity managers can pull in that private environment to build value. A great example of a typical solution for a company is to solve for succession planning when there's family transitions in family-founded businesses. This is a very good example of the sweet spot area in which Grosvenor focuses, what we refer to as the mid-market. For the mid-market buyout market, we consider funds or managers of then investing companies that are approximately less than $2 billion and companies that have an enterprise value less than about $1.5 billion down to $500 million. Now, solving for a succession is when we're able to go in, look at a company that is otherwise orphaned by next generation, perhaps take over a portion of it or all of it, and simply professionalize the systems around it, operational efficiency, adding some software efficiency, adding additional talent, increasing the footprint, expanding the product offering, adding growth equity for ultimate expansion, and literally creating new markets to expand that opportunity therein. All of these are the types of levers that managers can pull in a private environment without having the concern of beating the street, if you will, for a listed equity. Now, Russ mentioned also that your public equities portfolio is actually literally just the tip of the iceberg relative to exposures that you could have for investments. You can see here, you're literally ignoring approximately 98% of the market of private companies. And those companies are only accessed through private managers and private equity managers. Now, that doesn't mean that all of those companies warrant investments or will turn out to be significant performers within a portfolio. However, it is a significant universe that is being ignored for potential value in your portfolio compared to your public equities portfolio. Furthermore, if you're looking to see what the listed universe looks like, that tip of the iceberg, it's melting, it's declining. 50% in the US alone since 1996, nearly 30% in Europe since 2001. Now, why is that? Well, it is increasingly complicated and expensive to become a publicly listed company. You have regulatory restrictions, reporting requirements, transparency requirements. All of those operational excellent components cost money, resources, and time. Typically those that mid-market companies certainly cannot afford or have access to, and others that simply find are too onerous to achieve and still create value to ultimately benefit their investors. So who is investing in that universe, that 98% of private markets? Well, the managers that allocate to it have actually seen an increase in the industry of AUM approximately 6-fold and that's going back just since 2000. That's a huge amount of AUM that's increasing in the marketplace, eligible to pursue best-in-class opportunities. And that trend is one that is continuing. There's a voracious appetite from institutional investors to invest in private equity, specifically amongst their alternatives portfolios. Now, that is because institutions understand the potential for long-term outperformance when investing in private equity. Institutions also have the ability to stomach and tolerate a long illiquid time period. This can be anywhere from 7 to 12 years, depending on the duration of a fund or a deal in which they're investing. It's a very long time before you get your capital back, and it's locked up. There are no redemption periods where you can pull in and out of a private equity holding. But that long hold and that illiquidity should be yielding a premium, as well as one that is somewhat sustainable and countercyclical to public markets. And these investors are increasing that allocation at a significant pace because their public equities portfolio are simply not giving them the performance and the alpha that they need in order to fund liabilities, pensioners that are retiring earlier and en masse, as well as achieving their actuarial rate of return. What about right on the home front in Australia? Well, you can see the Future Fund has approximately 15% allocation. I believe that's recently increased up towards 18%. Still significantly less than the average allocation in private equity. A public pension plan has an average of approximately 30% allocated to private equity today. Your superannuation funds, only 4%. So minimal exposure, significant room for growth. Let's take a look at the performance over the long term. I mentioned that this is long-term value creation, that there is some market cycle independence that we see. And the pursuit is for a premium for the illiquidity you're assuming. What you can see here is that outperformance has been repeatedly achieved globally. US, Europe, Asia, over 10, over 20 years. The dark blue bars here and down to the light blue bar in Asia represents the performance relative to a public market index, or a PME. Very common analysis when measuring private equity performance. We're simply mirroring the cash flows, buying and selling the index, the same time period that a manager would be calling capital and returning capital in the investment. What about headwinds? What about significant market downturns? What about the global financial crisis? Very common question that we get. This is an analysis here that gives you a sense of how private equity as an asset class performed for those funds that were listed before the global financial crisis, where you will see that sustained outperformance, to during the financial crisis, where you see greater resiliency relative to public markets, and then after the financial crisis, where you are seeing even stronger outperformance. And let me unpackage these performance numbers a little bit for you to give you some context. The reason you're seeing this kind of performance and sustained growth and outperformance is really two main factors. One is that the companies that were being improved upon during the global financial crisis and just before, that had already been invested in by managers, those managers were able to retrench in the companies out of the public eye, not hitting the significant swings that the public market indices were seeing. Focus on adding talent on the cheap, creating greater efficiencies, and producing very healthy assets, well poised for acquisition post-global financial crisis. Further, the companies that were invested in during the financial crisis, the midst of it, and then later exited, they were purchased off of trough earnings, very low valuations relative to what you typically see in the market, and able to sell at a higher return because the threshold for an exit was even lower to get significant cash on, cash back. So I always say that a good private equity manager likes a good recession. That's because those dynamics have actually produced some of the strongest performance in the industry after every single financial crisis recession or downturn that we've seen in the market. And there's been one every 7 years since World War I. So what about your portfolios? Well, if you look at a typical 60-40 equities, fixed income or bond portfolio, you can see what the return profile looks like there. If you were to add just 20% to private equity, you can see here exactly the kind of outperformance and the alpha boost you can get without moving the needle on volatility. Now, of course, this is subject to accessing those best managers and having the right partner and access and the diligence and the portfolio construction and diversification that we'll talk about. But there is a lift and an outperformance, and we call pushing out the efficiency frontier when adding it to a traditional public equities and bond portfolio mix. So just to recap on some key facts to keep in mind here about the industry, public companies, literally just the tip of the iceberg compared to where your portfolio could have exposures. Furthermore, that tip is melting. Fewer companies are being listed. The universe is declining. The appetite and allocation to private equity, way up on a global basis. Here on the home front in Australia, minimum exposure, lots of room for growth, little access. The performance that you're looking to achieve ideally is sustained in targeting outperformance across multiple long-term cycles. And there is that potential for the portfolio construction to diversify the risk, even in a significant macroeconomic headwind or a market downturn. So let's just define now some of the nuts and bolts that are putting together the portfolio solution that we're pleased to offer alongside Pengana here. We already spoke a little bit about GCM Grosvenor and who we are and what we do. We talk about the concept of the mid-market. Now that is an area where we see less efficiency and greater breadth of opportunities. We also talked about the concept of having a bespoke platform and always being in the market and what that means for increasing your funnel, your access, your flow. Also access to information. We have significant resources that can provide the breadth of information across all industries and asset classes. We have local offices that are unlocking opportunities in otherwise underserved regions. And we have a global team because we believe you must have feet on the street and you must be local, global and local, when you're sourcing the best-in-class opportunities. So how are we doing this? What are the strategies that are going to be present in this solution? There are three main strategies of private equity, and all three of these are featured in this offering. The first are your primary funds. Now, this is your backbone of a portfolio in private equity. It is where you are ideally accessing what we call top quartile or best-in-class performing managers. And access is very important here. You'll see why in a moment. These are the managers in which you're identifying the best of the best. You're accessing them, not only identifying them, you're receiving an allocation from them, and you are entrusting them with your capital to execute on the same proven strategy under the best terms and with the same investment professionals that have historically produced those top returns on a go-forward basis. You allocate the capital, you commit the capital today. It's not all invested today. It is gradually called down over time. Typically 3 to 4 years is one private equity cycle. You're getting time diversification and forward-looking diversification. You allocate today. Those are the managers you are entrusting to execute on the best opportunities 3 years from now. And this is why we say you cannot time the private equity market. You must be present in them and entrust the allocations to the best managers. Secondaries are essentially used private equity. They're positions that an investor holds, and for whatever reason, they need to sell it. They need to liquidate it, whether they're reconstructing and adjusting their portfolio construction, paring down exposures, or whether they simply need some liquidity and some capital. These positions are in existing pools, existing funds. You can look and see exactly what it is you're holding. And they're typically purchased at a discount to net asset value, sometimes at par or at a premium, depending on how much conviction a manager has and where those underlying companies are going to ultimately sell at and how much value they're going to create. But the original holder has absorbed most of the fees associated with those. So you're looking at less fees here. But you're also looking at capital that is put to work on day one when you make the investment, and some yet to be called, depending on how mature those holdings are. But your capital goes out faster and it comes back faster. It is a different cash flow pace, one that is complementary to a primary fund. And this is giving you backward vintage year diversification, anywhere from 10 to 15 years in the past sometimes, by making one investment today. And then lastly, co-investments. This is the most concentrated investment that you can make within a portfolio. Instead of investing in a fund that will invest in many companies or purchasing a pool of assets that have many underlying companies in it, you're literally investing side by side with one of those fund managers in one company. That means that you need to be able to pick the best of the best, cherry pick those companies. And these are all companies that are backed and are invested by another manager. These are companies where I just said there's no way to time the private equity market. Well, this is the way that you actually can demonstrate where you might have conviction around a strategy or a theme, tactically, if you will. You invest at that point in time in that company, your capital is fully invested, it is called down, your capital goes to work faster and it comes back faster as well, because that one company is ideally sold, liquidated, and returning capital faster than an entire fund or a pool of companies that are yet to be invested in. Co-investments work as your alpha enhancer. And all three of these come together very synergistically in order to create maximum deal flow for a manager. You invest in a primary fund. That primary fund manager is ultimately the one who decides who gets to purchase the secondary position, not the investor who's holding it, but the fund manager who the position is in. And they also get to decide who participates in a co-investment opportunity. So the cycle goes around very synergistically, increasing deal flow for a manager who's active in all three areas of the asset class. Now, we're active in all three on a global basis. We think that gives us an advantage to pass on to our clients with a bird's eye view of the asset class. Now, I talked about manager selection being so important on a primary side. I want to pause on this next slide here and have you take a look at that. You're seeing the difference between 10, 15 years, North America, rest of world, between a low, a median, and an upper quartile performing manager. Now, this is why we're targeting those upper quartile returns for our clients. We seek managers that will produce consistent top quartile performance because there is a tremendous difference between being a median player versus a top player, even more so if you're low quartile. And this is one of the key risks in the asset class. Are you able to access and identify the best of the best in a consistent way? And top quartile managers in private equity tend to stay top quartile managers in private equity. They tend to not need new capital. They tend to not allow new investors in. You have a re-up from your existing investor base. It's frequently not broadly advertised when they're raising a new fund because they're simply returning to their loyal investor base. Hopefully you can increase your allocation there. And if you're so lucky to participate in a top quartile manager, the minimum investment is typically $10 million just to have a seat at the table. Something very difficult for any retail investor, certainly, to participate in. So the asset class may sound too good to be true. It is not. There are risks associated with it. And this is just a couple of examples. I want you to keep these risks in mind because when Russ comes in just a minute to wrap up what the offering looks like, we believe we've structured a solution for PE1 that addresses all of these risks in a way that we believe makes it much more accessible for a retail client. Portfolio companies, one individual company, can have significant risk, financial risk associated with it. And you must have a high degree of conviction behind it, or you can diversify it away by having greater companies in there. I talked about the illiquidity. You have to have the appetite to not get your money back in private equity for many years. Something not quite ideal for an individual investor. There is always that headwind, macroeconomic risk. If you're too concentrated in one particular year, one strategy, one sector, having the diversification there is critical. It takes a very long time to get that capital back, but when it does produce returns, it trickles in over time. It's not all at once. And you are literally counting on the manager to which you entrust your capital to do what they are saying they're going to do and what they've done in the past. That's why it's called a blind pool. So you must be able to do the diligence to identify the best of the best. So just in the last part here, let me tell you a little bit about Grosvenor's approach, why we think it is differentiated in the marketplace, and how we're going to bear some of those executed approaches onto this portfolio to produce the returns that we're targeting for our clients. Our philosophy is relatively simple. It's fewer better. Allocate to fewer managers and make them the best of the best, and constantly seek to upgrade the portfolio for our clients. And here are the examples stepwise of how we do that. We target those top quartile managers when we're building a portfolio. And to do that, you have to be proactive in sourcing co-investments, secondaries, and managers. The best of the best do not come knocking on your door. And you need to have a very wide funnel and a lot of resources executing on that. We leverage our relationships, having been in the industry over many cycles, being a large player in the market, having all of these bespoke solutions so that we can make significant commitments, frequently negotiating discounts, and pass that savings on directly to our clients. We implement top-down diversification when we build portfolios. We want to have that time, the vintage year diversification. We want to have the complementary strategies, not too much exposure to one sector or even to one manager for that matter, to manage risk. And I said that private equity is exactly what it's called. It's private. That means you need to have access to information. Information asymmetry is the key differentiator when making decisions to construct portfolios and to accessing information. That means if you have more relationships, better continuity of team in place, better technology to maintain that information over the long term and to evaluate trends, then ideally you can make better decisions that generates the best performance on behalf of your clients. And lastly, we are one of the largest backers in the industry of emerging managers. Now, that does not mean a first-time investor, to be clear. This means a proven investment professional who frequently is spinning out of one of the larger household name funds, the type that we don't frequently invest in at all, actually, at the larger end of the market. Those people like to form their own shop and own their own destiny, their strategy, their economics. Very increasing phenomenon we're seeing in the marketplace with a lot of succession planning happening at the large end of the market. When you back those managers in a big way, and when you're the first call, when they're looking to establish their new business, that is a very different relationship over the long term. Come fund 2, 3, and 4, when they're no longer accepting capital from clients, we still have a seat at the table, even though we're not the largest investor any longer. And even if they've grown too large and out of our scope, we still participate in co-investments with them. In fact, over 60% of the time, we are the sole or co-lead investor. And when you're sitting right opposite that manager and not with 5 or 6 other syndicate members, that is a very different negotiation that you're making and value we can pass on to our clients. So how do we do this on behalf of our clients? Well, take a look at these numbers here. We literally boil the ocean in pursuit of the best opportunities. And in order to do this, you must have a deep team, a team that has specific training and resources for evaluating a primary fund, pricing a secondary transaction, or evaluating a co-investment, and we do have discrete teams in all three strategies. But you need to be proactive, and you can see here, casting that net as wide as possible has produced almost 9,000 funds sourced since 2000. That is a lot of funds and a lot of throughput. You also need to have an institutionalized and efficient process by which to evaluate those funds and a tight screen and robust due diligence. And that's what's resulted in only about 8% of managers actually securing capital from us on behalf of our investors. On the deal side, the co-investment side, for the last 10 years, we have seen approximately 1 deal a day. And for the last 8 years, we've closed on a deal about every 2 weeks. That is a tremendous amount of throughput and work and evaluation and sourcing. And you can see only about 7% of companies actually secure commitment from us. And even at the top end of that funnel, this is a co-investment strategy. So every single one of those companies has been backed by another manager, almost a first screen, with us being a second screen, if you will. And how do we do that? Well, you'll see on the next slide here, a lot of boxes. This is our institutionalized decision-making process. And I'm not going to take you through all of it, but there are two main things to know. One, it's robust and comprehensive. Two, it is institutionalized. And what you can see below that dotted line is probably the most unique aspect of it relative to some other managers in the marketplace. Now, at the very beginning of my discussion, I mentioned that we invest in all alternatives. We've been able to take some best practices, honed, cultivated, and sourced on the hedge side of the business and carry them over to private markets. For example, you do not frequently see operational due diligence in private equity managers. You do see it in hedge funds, though. It's not quite a household name in private equity yet. We have a dedicated team of ODD, operational due diligence professionals. Now, they're specifically trained in tax law, in regulatory compliance standards, former SEC investigators, CIA-trained background research people, cybersecurity professionals. We think that back office is as important a risk as front office and investment strategies, and have this team focus in their deep areas of expertise and allow the investment professionals to focus on the investment, the merits, the market opportunity, the track record. That is an added layer of risk controls. Further, the decision-making process we execute is two-track. There's an investment committee, and you see also here an operations committee comprised of different people, but approval is required at both layers before an opportunity secures an investment from GROSVENOR for our clients. And we believe that is a very robust screen. In fact, moving on, you can see exactly how many deals and how much capital, and how many years we've been doing this by executing that systematic process. You can see here the volume across different strategies, the vintage years, nearly 28 billion that we've committed to private equity across this time period. What's important to note isn't just the volume of the numbers, but it's what's behind this, and that's pattern recognition. That's identifying what happens in different cycles. It's being in the flow and the tenure of the relationships and the consistency of relationships that comes with this kind of execution. And what we'll bring to our clients in this particular solution is on the next slide, and that is meaningful diversification. I talked about the top down, the exposures that can mitigate risk. Well, here you can see the range of what we would recommend for this particular offering, and it will result in 127 underlying funds and over 600 companies. Now that means that no one is going to significantly move the needle in either direction, up or down. We want to focus for consistent, straight down the middle performance, accessing the best managers with appropriate diversification. We're literally cutting off the tails at both ends of the portfolio. We're not swinging for the fences, and we're not looking to have significant downside risk either. And you can see visually what that looks like next here. We talked about the forward-looking vintage year diversification that a primary fund manager brings you, the backward from secondaries, and those concentrated positions in co-investments. There's also diversification by geography and by strategy. In geography, we recommend allocating to some of the deepest pools of managers in the marketplace, and that's going to be in North America and Europe. And we're global practice. We're not North America biased, but we have a bias towards the risk profile for this particular solution and overweighting it to North America mid-market. The buyout allocation you see on the right is that mid-market focus, complemented by special situations and by some growth equity in there as well. This is not venture capital. These are not early stage concepts that are being funded. These are, again, proven business models and companies with revenues that are looking to grow and expand. And lastly, you can see here exactly how that portfolio will build over time before we get to a year 4, which is what we would consider the steady state exposure. And we think we're doing something somewhat unique here in year 1, in particular, that 57% allocation to short duration credit. These are credit managers with which we can negotiate a separate account, something like a PIMCO or a TCW, where we're generating 4 to 5%. Is really a holding place for capital that has already been committed to primary managers, but they have not yet called down the capital. We never want to position ourselves to potentially be in default, not able to fund capital calls, and we want that capital put to work, doing some kind of nominal performance in year 1. And Russ will explain what the target performances will be over those years, in particular, what the Pengana alignment shares will be achieving for those participating in the IPO. Year 2, 3, and 4, that short duration credit is rapidly called down as the managers call capital to ultimately bring you to that top-down diversification in year 4, complemented by the bottom-up. Managers and performance in private equity are all about the bottom-up. And that is where we're executing that repeatable process that every other portfolio that we manage goes through, with the same investment professionals to identify the best of the best, to participate in a pro rata allocation. And this is targeting the type of exposure that we would recommend to any large, major, sophisticated institutional investor who is a new entrant to the asset class. So with that, hopefully, I'm able to leave you with some 6 key facts to think about with private equity, what the nuts and bolts are that comprise a portfolio and how they work in concert to mitigate risk and target outperformance, and then how we at Grosvenor execute that strategy and how we intend to deliver it here in this solution for a retail client. I'm going to ask Russ to pick it up from here now and tell you a little bit more about the specific offering, and then Jonathan and I welcome your questions.
Thank you, Aris. As I mentioned previously, there's 2 key issues that prevent direct investors from investing into private equity. The first of these is access. How does a direct investor access top-tier private equity? And I think after listening to Aris, you get a good feeling as to how Grosvenor does it, and I think I would have some confidence that Grosvenor will be able to do this for the investors in the trust. The second big issue that investors face is liquidity, in particular, if investors are going to invest directly into a private equity fund, they need to be happy to be locked into this fund for the next 10 to 15 years. Private equity is a very long-term investment, and this has prevented a lot of direct investors from going into private equity because they might actually need access to that money over the coming 10 or 15 years. So that's been the major impediment. We at Pengana have sought to solve for this issue of lack of liquidity. And the way we have done this is not particularly novel. In fact, it's something that's very well established in the industry, and it's something that has been utilized by the property trust industry for a few decades now. And that is that when you have a very illiquid underlying asset class like property is, how do you get it into the hands of retail investors or direct investors in a very easy to use format without and providing them with liquidity? And the way that the property trust industry did this was to unitize their property trusts and to list those trusts on the market, which created the listed property trust. We see a proliferation of these types of vehicles in the market: listed property trust, listed infrastructure trust, etc. Our trust looks very similar to it's very similar to a listed property trust or infrastructure trust. The only difference here being that our underlying asset class is private equity rather than property or infrastructure. What this means is that it allows GROSVENOR to put together the optimal private equity portfolio without having to worry about redemptions from investors. So the portfolio does not need to hold cash in order to fund redemptions. We don't need to sell assets in order to fund redemptions. We can manage the portfolio to the best extent possible. We also have put in place a distribution yield for the strategy, and we're targeting a 4% distribution yield on the net asset value. And as the net asset value of the fund grows over time, so would the 4% grow in dollar terms because of the growth of the underlying capital. So we think that this vehicle is a particularly attractive vehicle, not just because of the strong return features that it's capturing in terms of a private equity return profile, but also because it's got a distribution yield, a satisfactory distribution yield of 4%, and so therefore can potentially fit both into growth portfolios as well as yield portfolios. We are doing something in this portfolio, which in this listing, which is very unique in the marketplace, and it is a market first, and it is designed to provide a significant benefit to our investors who come into the RPO. So the first thing that we are doing, which is not particularly novel in the market and it's become accepted market practice, is we at Pengana will be paying the cost of the offer, and investors are used to seeing this over the last couple of years, that the vehicle itself does not pay the cost of the offer, the fund manager does, and therefore when the investor puts $1 into the RPO and it opens up on day one, the net asset value is $1, and so they don't suffer from any deficit because of payment of costs. We will be doing the same thing and funding 100% of the offer cost. But we're going an extra step and doing something, as I said, which is very unique in the marketplace. And what we're doing here is we will be providing investors with an estimated 5% immediate uplift upon the listing of the vehicle. So investors who put $1 into the RPO would therefore get $1.05 of NAV on day one. How are we doing this? We are taking some assets, some of our assets, and putting them into the vehicle. The assets that we will be putting into the vehicle are shares in our publicly listed operating company, Pengana Capital Group, PCG. And so I'll give you an example of how this works. If we raise a $600 million, which is the top end of our range, 5% of $600 million is $30 million. We would issue $30 million of PCG shares, new shares in PCG, to the value of $30 million, and we will put them into the trust for a total cost of $1. So we'll put in an asset of $30 million in for a cost of $1. This will effectively give all investors who come into the trust that immediate estimated uplift of 5% on their investments in their asset value terms. So while we're doing this, for a few reasons. Firstly, the first one to point out is that this vehicle is obviously very valuable for Pengana as a fund manager, and it will create value for Pengana shareholders. We have sought here to share some of that value creation with investors in the trust in order to align ourselves with those investors, and also in order to show appreciation for them giving us their custom investing with us into this vehicle. And so there's a lot of value creation, and we are sharing some of that in value creation with investors, and our investors in the trust will ultimately become shareholders in Pengana Capital Group through this vehicle. These shares will stay within the trust for the first 2 years and treated like any other asset within the trust. After 2 years, we will have a distribution, what we call an in-specie distribution, whereby instead of distributing cash, we will distribute these shares to the underlying unit holders, and so unit holders will own the PCG shares in their own rights. So briefly, Briefly summarizing the offer, we are providing our investors with an alternative strategy which have low levels of correlation with listed equities. One thing I forgot to mention, I should have mentioned, is that the underlying investments are mostly in US dollars, some of it in euros and some of it in a mixture of basket of currencies, but predominantly US dollars. And what we find with US dollars is that this provides, in our view, an additional hedge into the portfolio, and that is what you usually find in times of equity market falls. The Aussie dollar usually falls with the equity markets, and so because these assets are US dollar, predominantly US dollar based, if that happens, then you'll actually find an increase in the value of the portfolio. So we think that the US dollar basis provides for an additional protection for the portfolio. So it is an alternative strategy, low levels of correlation, managed by Grosvenor Capital, certainly have got a great credibility in the space. We're targeting strong returns for the strategy as well as a distribution yield of 4%. With regards to some of the details of the offer, as I mentioned, minimum of 100 million, maximum size of 600 million. The offer opened on the 4th of March, and the offer will close on the 10th of April. The underlying fees of the trust, this is what we call a two-layer of fee structure. The private equity funds down below, they obviously get paid for managing the money down below, but we also have a layer of fees at the top, which is shared by Pengana and Grosvenor. This is not a three-layer of fee vehicle where Pengana picks up a fee, Grosvenor picks up a fee, and the underlying managers pick up a fee. At the top level, Pengana and Grosvenor share in the fee structure. We think compared to other vehicles, both within the Australian marketplace as well as in the global marketplace, it is a very competitive, if not compelling fee structure that's better than what we've seen elsewhere in the marketplace. I'll finally just finish off with the disclaimer. Obviously important to not only read the disclaimer, but for those of you who are looking to invest to read the PDS. And as I say, also consult with your advisors.